What is up, YouTube? Welcome back to another book review. Today we're going to be talking about Ray Dalio's Big Debt Crises. For those of you who are unfamiliar with Ray Dalio, he is the CEO and Chief Investment Officer at Bridgewater and Associates, which is the largest hedge fund in the United States. Multiple $billion under management, and he's my favorite investor. He wrote a book called Principles that I did a book review. I'll have that linked in the description. He also made a video called How the Economic Machine Works. It's like a 20-minute animated video. I'll have that linked in the description as well. I highly recommend people check these two videos out. Ray is at a point in his life now where he is just trying to share so much of the wealth and good fortune that he has been able to accumulate in the form of knowledge, experience, and financial assets as well with the world. And he recently was on 60 Minutes talking about, I think it was 60 Minutes, might have been something else, but he was talking about reforming capitalism and discussing his ideas on why capitalism isn't working. But one of the reasons why Dalio has been so successful is his ability to sidestep global economic crises, particularly the housing debt market crises of 2008. And this three-part book is essentially his way of explaining how big debt crises evolve. And he goes through, the book it's written into three parts. The first part, he talks about sort of like the archetype of deflationary and inflationary debt crises. The second part, he goes through three case studies, two in the United States, one in Germany, the Weimar Republic. So he talks about the U.S. debt crisis from 1928 to 37, the debt crisis from 2007, 2011, and then the debt crisis of hyperinflation in Germany from 1918 to 1924. And this book review is going to be a long one, I think. And the reason that it's going to be long is because the reason I'm making this video is the reason why I read this book is I have for at least the last year and a half, and part of this has been influenced by Dalio going around talking about he thinks that it's possible that we are in the late stages of another debt crisis. He says we're probably in the 7th inning last time I heard him speak. And these are sentiments that that resonate with me. And so anytime a great investor, a smart man like Dalio writes a book, I have to read it. It took me a while to get through, and it's going to be difficult for me to talk about this book in part because I know what I don't know, and Dalio has, this book is written at a very high level. I think its targeted audience is probably investors, people managing millions, billions of dollars in management, but also policymakers. And just some notes about the book. I like my favorite part about part 2. Oh, I didn't talk about part 3. Part 3 of the book is 48 other case studies, right? So when he comes up with these archetypes for inflationary and deflationary depressions, he looks at, I think it's 27 cases of each sort of depression and creates this general archetype. Then he goes into, the 3 specific examples that he wants to highlight, and then he goes into 48 case studies, a lot of charts in part 3. But one thing I really liked about the way part 2 is structured is that you see here on the side of every page, as he's going through the history of the debt crises, he's giving you a newsreel from credible sources like the New York Times, the Washington Post, the Wall Street Journal, and letting the reader experience sort of what's going on in the media during this time, and the psychology of the people and the information that they're taking in, and while he's providing an analysis of what's actually going on in the markets. I'm going to sort of go through the archetype of deflationary and inflationary crises. So all debt crises start because of credit, right? And credit is the expansion of money in a market. And crises or debt crises, recessions, depressions come because credit flows in cycles. And you can reference that video, The Global Machine by Ray Dalio, where he goes into depth about these cycles. You have the big cycle and you have small business cycles, but these cycles come about because the expansion and contraction of credit, right? And obviously when credit is expanding, more people are able to spend, but when people are able to spend more, there has to come a time where they're not spending as much because they have to pay off that debt. So then there's a contraction, and this flows in cycles, right? And so this is the cause of big debt crises is credit. And so for deflationary depression, you have sort of 7 stages that Dalio points out in his books. You have the early part of the cycle, you have the bubble part of the cycle, you have the top part of the cycle, which Ray says is defined by sort of a bull market and asset prices going really high. People sort of start pushing, extrapolating into the future, the good times, and then obviously this leads to a top. The 4th stage is you have a depression. During a depression, policymakers have 4 different levers that they're able to pull in order to get us out of a depression. You have debt restructuring, you have money printing, you have austerity, which is basically spending less, and then you have wealth redistribution. The 5th stage is the deleveraging stage. He comes up with this idea of a beautiful deleveraging, which is when policymakers move those 4 levers in a harmonious fashion. Then you have pushing a string. This part is sort of late stage of the debt crises, a period of slow growth. And then you have normalization, where things go back to normal. And deflationary depressions are different from inflationary depressions in that the prices of assets, real assets, is falling, and the currency stays strong. Meaning the value or the unit of the dollar, right? So a lot of people they're fleeing from stocks, they're trying to get out of bonds and real estate, and there's a sort of a flee to cash, right? Which differs from inflationary depressions, which is what we're going to talk about mostly in this video for a number of reasons. But inflationary depressions, they follow a similar archetype. You have the early part, you have the bubble, you have the top, then you have depression, and then you have normalization. However, in an inflationary depression, the value of a currency is dropping, it's being depleted, and this is due to money printing. However, what Ray points out is that money printing is not the money printing is not the cause of hyperinflation, it's actually the result, right? So money printing comes a lot later in the stage, in the cycle, after policymakers try to defend the currency, which is really why I'm excited to make this video, because I have beliefs about how things are moving in the global macro economy right now. Very timely to make this video. I wrote these numbers down on the board. I'm just going to read them. This is from the Spectator Index, and these are inflationary percentages of different countries around the world, right? So Venezuela in 2019. So Venezuela, 10 million percent. Zimbabwe, 73%, Sudan 49%, Argentina 43%, Iran 37%, Turkey 17%, Haiti 14%, Nigeria 11%. So these are the percent, like the rate of inflation of these different countries. And whenever I first got into Bitcoin, which those of you who are familiar with my work, you know that I am a Bitcoiner. I talk a lot about Bitcoin on my channel, and you guys should check out those videos if you haven't. But anyways, one of my theses early on was that countries with weak currencies, citizens were going to find refuge in Bitcoin, because Bitcoin was, sort of this decentralized, stateless, permissionless global currency, and it was fixed supply. And so I believe that it would be the weaker currencies that would die off first, and then eventually, things like the euro, the dollar, the Japanese yuan, these stronger currencies will come later in the cycle, and I still believe that that's the case. I just listed just some countries. This isn't even all the countries that are experiencing really, really high rates of inflation, and this is very sad that this is taking place in parts of these worlds, and I can't even understand what that would be like. But I'm going to go ahead and pull out part 1 of the big debt crises and just read some passages and offer some thoughts about different things in here and how I see, it was very interesting, because it seems to me like Dalio is making a prediction about how things are going to play out without saying it, without being explicit, right? And maybe that's because in the past he's made claims and it's come back to bite him, and he's gotten older and wiser and a little bit more tactful. But it's interesting how he frames this book, right? And thinking about the way he wants the reader to read the book, it's not just read it all the way through. He actually introduces the deflationary archetype. Then he tells you to go read the 2 case studies in the United States. And then he says go back to the inflationary archetype and then go read the German debt crises of the early 1900s. And when you go to the inflationary archetype, he doesn't like talk about countries by name, right? Because he's creating a framework. But in this weird way, it seems like he's getting at or implying the United States in some of these passages. And I think what was the part that really hit it home for me, that he was really trying to, provide a warning to us, is that at the end, one of the last parts of the inflationary archetype, he talks about war economies. And he talks about how trade wars lead to real wars. And, sort of this balance of power that is at play as it relates to global economies and superpowers and dominant powers and who creates the rules and global currencies, right? So let's just get into these passages I want to read from. On page 39, towards the bottom, it says, while it is widely known that central banks manage the trade-offs between inflation and growth by changing interest rates and liquidity in the system, what is not widely known is that the central bank's trade-offs between inflation and growth are easier to manage when money is flowing into a country's currency/debt and more difficult to manage when it's flowing out. So, in summary, it's easier for central banks to manage debt crises whenever money is flowing into their currency versus money flowing out, right? And I know for a fact that money is almost like every day flowing out of the US into Bitcoin. People are fleeing to Bitcoin as a reserve, safe haven, digital, permissionless store value that can't be confiscated. You can look at things like Cash App and look at their revenue and sales of Bitcoin and know that this is happening. Or you can just go on Bitcoin Twitter and see like every Saturday when everyone posts their Cash App Bitcoin buys, like people are, they're leaving the system. They're moving to a different system. I've made a lot of videos about digital economies and how I believe the digital economy, dark markets are growing at the same time that the real world economy is shrinking, right? And so that's really interesting. Then he goes into what types of countries are most vulnerable to severe inflationary depressions. He says these are countries that don't have a reserve currency, that have low foreign exchange reserves, that have a large foreign debt, have a large increasing budget and or current account deficit, have negative real interest rates, have a history of high inflation and negative total returns in the currency, right? So some of these things apply to the United States, some of them do not. A lot of these things apply to some of those countries I talked about earlier, right? But I think the most interesting one is like your currency being used as a global reserve currency, which is like a unique position the United States holds in the world. Some people call this the petroleum dollar or something like that. The fact is that there are very few countries that their currency is used as a reserve currency, and the United States is one. So this kind of gives us a protection against an inflationary depression. But he goes on to say that it's not impossible for countries like the United States to experience hyperinflation. So read a couple more passages. Can reserve currency countries that don't have significant foreign currency debt have inflationary depressions? While they are much less likely to have inflationary contractions that are as severe, they can have inflationary depressions, though they emerge more slowly and later in the deleveraging process after a sustained and repeated overuse of stimulation to reverse deflationary deleveraging. So this to me, I think about, it's very clear to me that there's a panic by central bankers going on. And part of the evidence of this is that recently the head of the Federal Reserve was on 60 Minutes, and that has never happened. Why is he going on 60 Minutes trying to almost convince the economy and convince everyone in the United States everything's good, we got things under control? You can go back and read the minutes. And this is interesting. The Fed doesn't release their minutes from their meetings until like 5 or 10 years later. So you can't actually hear what's going on in their meetings. We won't ever know. We will know, but it'll be a lot later. So continuing on. Oh, I was just going to say that basically it seems to me like there's, central bankers have been trying to, they can't increase the interest rate without like basically destroying the economy right now. They're in such a predicament, and at the same time, our debt is in the trillions of dollars, right? Like it's literally, and now there's talks about negative interest rates, which, like conceptually, I still like. It just seems like silliness. I know there are some European countries who've already experimented with this. So yeah, people are trying crazy things in this experiment right now. That is fiat money. Let's go on. If a reserve currency country permits much higher inflation in order to keep growth stronger by printing lots of money, it can further undermine demand for its currency, erode its reserve currency status, example, make investors view it as less of a storehold of wealth, and turn its deleveraging into an inflationary one. So, long story short there, the TDL is that we need to be very careful with how we manage inflation and what is possibly the late stages of a depression, right? And we want to be safe to make sure that our depression isn't an inflationary one. And I don't think it's impossible. This is actually my prediction, right? I'm just going to put this out there. My prediction is that like 98% of countries in the world are going to experience inflationary depressions, and the United States is going to experience a deflationary depression, while at the same time people are fleeing the United States dollar and going into gold and Bitcoin, but mostly Bitcoin. That's kind of how I think things are going to play out. And then Bitcoin's going to rise in price, and the dollar is not going to be as strong. And if this trade war with China goes on and it turns into a real war, Dalio has some things to say about wars, as I talked about earlier. He says, let's go to that. So I thought this was interesting. Typically, though not always, at times of economic rivalry, emotions run high. Firebrand populist leaders, Trump, who prefer antagonistic paths, Trump, are elected or come to power, and wars occur. This part he bolded. The debts and the outcome of the war, whether it is won or lost, will be enormous. The worst thing a country, hence a country's leaders, could ever do is get into a lot of debt and lose a war, because there's nothing more devastating. Above all else, don't do that. Look at what happened to Germany in World War I, right? So like, if you're going to war and you lose, you are screwed. You are screwed, because you're going to have a lot of debt afterwards, and your currency is not going to be as valuable. I think there was one more quote that I really wanted to talk about. So this part comes from page 46 of part 1, where Dalio is talking about the top, so stage 3 of inflationary depressions, which is currency defense. So the top anchored in currency defense. And he says, weakening capital flows are often the first shoe to drop in a balance of payment crises. They directly cause growth to weaken because the investment and consumption they had been financing is reduced. This makes domestic borrowers seem less creditworthy, which makes foreigners less willing to lend and provide capital. So the weakening is self-reinforcing. Growth slows relative to potential as the pace of capital inflows slows. Domestic capital outflows pick up. Export earnings fall due to falling prices or falling quantities sold. Typically, exports are flat, no longer rising. The trade war that we are entering with China, I believe, is going to make export earnings fall, and quantities sold is going to fall. And then also domestic capital outflows pick up. I already talked about people are buying Bitcoin in large droves. People who are wanting to find some way to store their wealth, their labor. They do not trust the dollar. They are moving, they're exiting this financial system and choosing to involve themselves in an alternative system. So those things are happening. Those things are taking place. And so these are some the causes of the reversal, right? So the top, whenever you've topped in the bubble part of hyperinflation, these are some of the causes of a reversal. The income from selling goods and services to foreigners drops. The cost of items bought from abroad or the cost of borrowing rises. Declines in capital flows coming into the country. A tightening of monetary policy in the local currency and in the currency those debts are denominated in. A country's own citizens or companies want to get their money out of the country/currency. Yeah, I'm going to end this video there primarily because it's already really long. But I think I've just kind of, the reason I wanted to make this video is because I think I'm right. I think although I might not have all the expertise to comment on or to give like sort of a really good analysis of his book, just because I do think it's written at a really high language, I also just think it's important that I document this part of my journey because I do take myself as an investor very seriously and my continual education very seriously, and reading books that are out of sort of out of my level and my realm of expertise and knowledge, I think is important for growth because I learn new things, I learn new ways of thinking, new frameworks, new terminology, and also just new ways to think about, you know, the economy. And so let me know what you guys think. If you've read this book, let me know what you guys think about my analysis. If you thought there were things that were weak, you thought things that were interesting, anything you want to put in the comments, please do. And also follow me on Twitter at elima_III. I talk a lot about investing. I talk a lot about life, self-improvement, Bitcoin, and whatever other random musings come into my mind. So thank you guys for watching. I'll see you in the next video. Peace.